Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Hello, everybody, and welcome to Digital Currents. This is Xavier riding solo again. I know what you all may be thinking. As the weeks pass and we don't see Mark Yusko, the question surfaces, is he okay? I can assure you, Mark is A-okay. He's just enjoying some time off, well-deserved, off of the heels of a long trip out to Asia and doing some really great things out in Japan. And fear not, Digital Currents audience, while he's away, I'll continue to try to do my best with keeping everybody posted and up to speed on the latest in the ABCDs, how we define them: artificial intelligence, blockchain, computer chips, and big data. As we've said many times, these are the foundational blocks of what we view as the new internet. And as we all know, the internet changes every 10 to 15 years. And they're really pushed upon a couple of key technologies, from software driving innovations and really needs for better hardware. And when you get better hardware, you get better software. So think about any phone you've ever had, right? After a couple of years, let's just choose the iPhone. That's the one that I've had for some time. You have your iPhone, and after some time, there will be some issues with all of the bloatware or all of the apps that you have on your phone just running properly. There is a natural shelf life to hardware, but then also the software just keeps changing and requires better hardware to perform. So we, as a venture investor, are really keen on some of these developments. And so that's where we spend a lot of time analyzing what is happening in the public markets as well as the private markets, because they are so interlocked in terms of how public markets really rely upon and depend upon investment into private companies for innovation and growth. I've said many times that stocks get hammered when they step outside of the core competency of whatever that company is. So just think about any large technology company. I'll pick on Meta, a fellow Ardsley native, Mark Zuckerberg, which, fun fact, his dad was my dentist way back when I was a kid, although Mark technically was in Dobbs Ferry, but he attended Ardsley schools K through 8. So when Zuck was creating Facebook, over the years, they've launched many products, but when there is a big change or a big investment into an area, investors can get a little bit spooked if they think that it falls outside of the exact corporate arena of their mandate. And so just remember when Facebook or Meta changed their name to Meta, which was this idea of trying to become Metaverse Web3 company. Stock went down almost 70-80% from a market cap of 1 trillion down to under 300 million. And that resulted in a lot of about face that was done publicly by the company saying, no, we're not going to do this blockchain stuff. We're going to go all in on social media and being the best company that we can and focusing more on those kinds of products. So that is the preamble, as the courting of private investment by public-facing entities won't stop, because that's what they'll need to do to remain competitive and continue with their growth. And we'll point to one company now that is extremely divisive, and one that we have spoken a lot about here on Digital Currents, and that's TikTok. TikTok is 170 million users, but critically here, they are hugely over-indexed with some of the younger demographics in the United States. And so when you speak about Facebook or other platforms in the US and social media, those now represent a little bit more of a cross-section of America. So the ages and the communities that are using those platforms, it's very different from the folks that tend to be using TikTok. However, there has been a lot of issues raised ad nauseum about the security concerns around TikTok. And so the compromise is now being proposed that U.S. companies have until, I think, tomorrow, April 5th. Today we're recording this on Friday morning, as you all know, until April 5th to come to bat with what could be a resolution to buy TikTok, at least the parts that operate in the U.S., and run that here. And I thought that we had an ability to kind of solve this back in 2020. My old company, Big Red, aka Oracle, was in the driver's seat to be one of the, or be the acquirer for TikTok ahead of this weekend deadline. Now that we face, Oracle is still in the mix. But the thing is, there are many companies now vying for this title because this could represent one of the most strategic assets for U.S. technology company, right? And we're seeing the tech sector get hammered for a variety of reasons, tariffs, which we'll kind of make some discussion about, as a lot of information has been released ahead of Liberation Day, quote unquote. And now we're starting to see companies respond and thinking, what are they going to do next? I think this is going to lead towards what I've been calling for in 2025 as the exit year. Companies will continue to exit via M&A or IPO, depending upon, what is more suitable in their climate, right? So we have a lot of potential buyers, all right? So let's go and list a few. So we mentioned Big Red, Oracle. We have Andreessen Horowitz and Blackstone, so you have some VC attention in there. But then you also have the traditional technology companies, in addition to the Big Red. Amazon, Microsoft, AppLovin, which is a company that went public a number of years ago, was a startup. Frank McCourt and Kevin O'Leary, so of Shark Tank fame. Then you also have AI search startup Perplexity. So this is kind of an interesting one, private on private. And now you also have even YouTubers, conglomerate led by Mr. Beast and Roblox, the CEO there. So, really, what's at stake here? So the idea here is that, Chinese companies, they don't allow U.S. social media to operate in their country. So this is going to really continue to be a revolving political shift as Beijing and the U.S. Look to hopefully find some sort of harmony over the next couple of years. And what really started as this crusade against intellectual property theft has really morphed into these accusations of mass surveillance, algorithmic propaganda, and really manipulation of an entire generation of American youth. And that's kind of what we were describing at the top of the podcast, where the mass amount of 170 million users are far younger than on any social media platform here in the US. And the idea that these users can somehow be more at risk and they also protect themselves a little bit less than older users online, I think this is really just a matter of, a digital only type of audience versus an audience that grew up without the internet, coming and using digital technologies, and how that is fundamentally different in how these communities really interface with technology. In a younger generation, they're kind of used to getting hacked. It doesn't scare them in the same way that, let's say for me, it could be pretty frightening. I shared the story on vacation. It's always when you're on vacation, so you can never fully unwind. It's never the first day when you get there. It's when you've already settled in. For me, it was like day 3 or 4 of a 5-day vacation. We go into the pool, get all of our bag full of gear ready, and we had our son with us, our now almost 4-year-old. It takes, as everybody knows who had a family vacation recently, probably an hour to get to the pool or to any sort of activity when you've got so many bags, sunscreen, towels, food, snacks, water, and then you're finally ready. And then when you just sit back in that beach chair or in that poolside chair, you get those crazy alerts from your phone. And that's the moment that it happened for me when I realized that we were getting hacked because all of these unauthorized transactions were trying to go through. I immediately called up my bank. There was a huge issue because we're out of the country in the Dominican Republic at the time. And it eventually got resolved. But kind of going all the way back to TikTok, younger users just realize, hey, my bank can figure this out, or this is what's going to happen. It'll all be good. I'm not going to necessarily worry, or maybe it won't happen to me. I will continue using these platforms because they are that appealing to me. And of course, TikTok's appeal is it's a really good algorithm actually, which can help users better find content. And it's a short form content, very good for that young attention span, which is very flighting. And there really has not been a successful attempt for other companies to copy this type of information. Obviously, most famously, YouTube Shorts has something quite similar, but having used both, the algorithms are nowhere near as good. On YouTube, there are, you have that ability to have a short form video and to continue having content recommendations, and a lot of large creators, including Mr. Beast, who's trying to now buy the rights and the ability to control TikTok here in the US. So the creators are there, but just at the end of the day, that algorithm has not really been able to be replicated or surpassed, unlike what we have seen on the AI side. So specifically on Gen AI. So changing gears into the other big story of the day, OpenAI has secured $40 billion in funding, and they've reached $300 billion. Yes, $300 billion with a B valuation. And so this is one of the largest private funding rounds ever. And if it sounds like I'm repeating myself, I think I am. I feel like every couple of weeks I keep saying in the now largest funding round ever, or one of the largest funding rounds ever. This is very emblematic of what's happening today in AI. The rounds just keep getting larger and larger, and the idea here is that there will be a small group of winners that will come to dominate the LLM space, or the large language model space. And that's really the brain, the algorithm behind these generative AI platforms like OpenAI, which I use daily. I use it now instead of Google to find a lot of information. If I find that something is questionable, I will go and revert back to a Google search, or actually use something like Perplexity. Perplexity is this hybrid between what you might expect from a Google search and what you would expect to find in OpenAI. What that means is it cites its sources. You can have links to kind of click out into the open web to learn a little bit more about whatever it is you're searching for. And OpenAI now has really tried to respond to the challenge that DeepSeek, the Chinese startup, which we've spoken about extensively on Digital Currents, has posed to its pole position. DeepSeek famously raised under $6 million and was able to come to market with a algorithm and a solution that was almost on par with OpenAI. And of course, OpenAI had at that point raised, over $100 million in funding to develop its own algorithm, billions, to get to a point where a small company had been able to reach relatively quickly. The reports was that the company was, not even 2 years old. OpenAI has opened or began its operation over 5-7 years ago. And so now, as we look at this next move, in my opinion, I think this is a very large statement from some of the established tech players. As we know, OpenAI is Microsoft's big bet into the space. But this round is being led by SoftBank. So SoftBank is pledging 10 billion of the 40 billion, and that's going to be financed not just through equity, but a lot of it is coming from debt. And so the remainder of this balance, so the first 10 will be largely debt financed. The remainder of that 30 could be expected by early 2026. And SoftBank, which I have sort of made the accusation that is effectively the sovereign wealth fund of Japan, they invest notably in some of the largest tech deals of the recent memory and also of past memory. If we recall, They've had aggressive bets like Yahoo during the dot-com era that did not work out so well for them. So hopefully this will do a little bit better for them. But, even SoftBank has some limits. The reports are that they've got $31 billion in cash reserves, which obviously put a little bit of a ceiling on their debt. And they may need to sell some assets to be able to structure this. And that might result in my prediction of 2025 being the year of M&A and IPO, but not in the way that we would hope for. We want to have accretive M&A and accretive IPOs towards shareholder value. Another big condition for this round is that OpenAI converts to a for-profit model. And if you've been following the news with Elon and his continued pursuit around OpenAI and the litigation that he has brought against them, he's basically been really at odds with this idea of the for-profit versus non-profit ethos of the company. So OpenAI was established as a not-for-profit, but it has become anything but that. When you're sitting on some of the world's most powerful technology with some of the largest investors, it's only natural that the aims and the destination of your company will change. And so we have been seeing that, and now it's actually inked into the term sheet where that funding is conditional on becoming a for-profit model. And SoftBank has pledged $10 billion, but of course, some of the legacy investors are involved. Spoke about Microsoft. Co2 is another, Altimeter, and also Thrive. And that really, is going to be a thing that we're going to be watching here because, you've got 500 million weekly users for ChatGPT. And this is not just about trying to become the next Google search, which I've argued that that's kind of the short/near-term opportunity for OpenAI. But there is another project, an ambitious project called Stargate, and that's about building AI data centers across the US. And so this is how I opened the show, this idea of software developing at such a rapid rate that new hardware needs to be developed in order to keep up. And that allows the technology to grow and do more powerful things. And having that technology now be centered here in the US, obviously these chips are going to come from a variety of sources. If I had to guess, they're going to be continued to be powered by NVIDIA chips, although there will be a whole host of other chips that would be involved here. So I'll say that there is potential optimism on the idea that there is a decline in public AI valuations. This idea that the demand for AI chips and AI consumption will somehow decrease. I think this is really born out of a couple things. One, the multiples that we've seen on some of these companies like NVIDIA is extremely high. Something like over 30 or 40 times revenues, which is just a very large number. And the idea to be able to catch up to that means that you're going to have to continue as a chip company to sell more and more chips to justify your price per share. So if more and more data centers are going to be built with the assumption that there is a need for this, there's really a need to have more compute to power these AI models. Well, that's really what folks like SoftBank and Microsoft are betting the farm on, that this will continue, that people's need for connectivity and knowledge and information is only going to increase. But the gamble, the rub is, will it be made more efficient? Can it be done with cheaper models like what we see in DeepSeek that don't require such heavy use of the latest chips? Now, we recall that the model that DeepSeek used was trained on the older NVIDIA chips. They couldn't actually get their hands on the newer chips, and we'll talk a little bit about trade war and tariff because that is all the news right now, and it's affecting not just tech, but really every other industry that has been seeing really this notion of reciprocal tariffs being sprinkled in. So the idea of you tariff me, I tariff you. But if you kind of look a little bit more, I could have easily made this a chart of the week, but I'll just speak to it. The unveiling of the tariff program globally, it's touching, not just China, not just Taiwan, but really the majority of the countries in the world with the notion of a reciprocal tariff. But the math that's used here is a little fuzzy. It's really kind of speaking more towards a trade imbalance and trying to have a tariff that will effectively curtail the U.S. from becoming less of a buyer and more of a seller, to have a little bit more power in the market. And the shortcut hope here is that a tariff can accomplish that. What I have seen and what other economists have seen and claim to see is kind of the opposite effect. Having a tax on innovation really will result in getting passed down towards the consumer in the form of higher prices, higher barriers to entry to get things that they need and want. So as a startup, this could create opportunity to figure out how to do more things here onshore. But the challenge is you're still relying upon a global supply chain of compute that still is going to be subject to these tariffs. So more to come here. We hope that these will be short-lived, because as markets reel from this news, it is a difficult thing to witness. And how does it kind of affect our world? How does it affect the world of crypto and blockchain? Well, as more and more institutional investors come into our world and come into the world of understanding that Bitcoin can be this bearer asset, we're seeing a lot of challenge into the market. So crypto has suffered its worst performing Q1 since 2018. Yes, almost 7 years ago, the worst performing Q1, right? And so, what's really happening here? Let's start to zoom out. We're seeing that ETH and BTC ratio hit a 5-year low. That's also something we started speaking about before, which basically means that it's Bitcoin and then everybody else. Before, we were speaking about the big two and everybody else. It kind of reminds me a little bit, everybody knows I'm a huge college football fan. This reminds me a little bit of what they used to say about our conference, the Big Ten. I don't think we should be called that anymore. We have way too many teams in the conference, but it used to be called the Big Two, the Little Eight. So it was basically us and that other school in Ohio as the two teams. But now there are a million teams, and you see a lot more attempts at parity, but it's not really the case if we look at crypto right now. So after ending sharp, very much in a lower position, we've closed out the worst performing Q1. And really the crypto prices started to rise a little bit this week, and they kind of waited for what was going to happen on Wednesday of the planned rollout of these new tariffs. And then, much like everything else in the economy, took a slide downward. So we started seeing not just BTC start to go down, but then also things like Ethereum and Solana. And the idea here is that economic uncertainty could continue to lead investors to seek Bitcoin, just as they have sought gold in recent months. So if there's one positive and bright spot in finance right now, it's definitely the gold trading. So gold is up over 3,000. It has been one of the flights to quality that investors have been seeking. And that is the same argument that people in my world use for Bitcoin. It is the flight to quality. Bitcoin is supposed to be the digital gold, but what we're seeing now is no, gold is gold and Bitcoin is something else, at least in the minds of financial institutional investors. So let's kind of unpack a little bit and think about, why have prices taken such a sharp dive in Q1? And so we were very jubilant. Mark and I were speaking a lot about these pro-crypto policy changes in Washington. We've been thinking about things like strategic Bitcoin and crypto stockpiles in places like Texas, and then other states, over 30. Some have now been put on the back burner. So some bills have been introduced. They have not passed. We continue to wait, and we'll bring you guys the updates if and when new states sign aboard. But of course, we don't have to wait for the U.S. to sign the board as a country, because President Trump signed the executive order to establish a federal reserve from crypto. But here is the rub. The challenge here was that it basically committed towards not selling any more of the crypto than it already has, right? And so that's really what markets reacted rather negatively to. The U.S. seized tons of crypto from the now defunct website, the Silk Road, which was, think about it as the Walmart for the dark web. You could buy all sorts of terrible things on there, and you were doing so in largely Bitcoin. That provided that sort of cloaking ability for supposedly a buyer and seller to do so in an anonymous fashion. Now, the problem is, as folks know, crypto actually leaves a paper trail, not just a paper trail, but even better, a digital footprint. There is a general ledger. It has been known as perhaps the greatest general ledger ever created by mankind. So it's not just something that people can use and cover up their tracks. There will be undoubtedly breadcrumbs for sleuths to follow and to unearth. When it comes to the Silk Road, all of these transactions were documented using the blockchain, so it became actually a tool for fighting crime. But the U.S. did seize the Bitcoin that was part of the website, and that basically became the foundation of our federal stockpile around crypto and Bitcoin. So the market really reacted rather severely, negatively, in terms of what was supposed to be a very exciting announcement on the strategic reserve around crypto. But there was no commitments about buying Bitcoin. There was really no schedules that were illuminated on when some of these things would come into place. So it was, in some ways, much to do about nothing. So that was kind of one of the key points that led to a little bit of a sharp decline. But then also, crypto-related stocks fell sharply, as well as the S&P 500. And as more and more institutional investors come into crypto, it's going to impact both the general macro environment is going to have an impact on what's happening within crypto. And it's going to cause investors to potentially liquidate and pull back when they feel some shock, and they will go into their own perceived version of quality, whether that's going into Bitcoin and away from things like Ethereum or Solana, where Solana was riding at 250, 260 all-time high, all the way down now at time of recording around $130 per soul, which is their crypto, and other things too, right? So the stubbornly high inflation that we've been seeing for years now, and interest rates which still remain high, and of course, what we're mentioning now, the impact of the tariff policy. So it's also challenging as well, because if you speak to anybody in Web3 and you ask them, what was the cause for movement on, Bitcoin up or down, you're going to get a myriad of answers. So at best, what we can do is look to see who is buying, who is selling, because as we mentioned, there is a general ledger, which shows all the transactions on the Bitcoin blockchain. I can pull that up since the beginning of time. I'm not going to necessarily be able to understand who is doing the buying and selling in terms of their identity, but their public address is visible, right? So with that, a lot of smarter people than me are able to make inferences about the entities that are doing the buying and the selling, and what that could mean for the overall market. And this leads to a lot of the vol that we have been seeing. But of course, someone who has remained very bullish on Bitcoin, the Secretary of Treasury, no, just kidding, the BlackRock CEO, who is, I joke only because of the outsized impact that he has in economically within the U.S. Larry Fink, they have more than 10 trillion, yes, trillion with a T assets under management. And in an annual letter to investors, he continues to cite the glowing importance of the global economy. And folks, this is an important thing. We're living in a world now where it is okay to write to your investors about the growing importance of Bitcoin as the largest asset manager on the planet. And he continues to write in this letter that every stock, every bond, every fund, every asset can be tokenized. And if they are, it will revolutionize investing as markets won't need to close. Transactions that take days can take seconds, and billions of dollars currently immobilized by settlement delays could be reinvested immediately back into the economy, generating more growth. So he's hitting on all the clear talking points. Clearly, it sounds like he's been watching Digital Currents. If you are, thank you so much, Larry. If you haven't, rate, review, and subscribe. Not just kidding. But in another part of the letter, he goes on to argue that the U.S. debt and deficits are really bludgeoning the dollar's status as the world's reserve currency. And this is the point, ladies and gentlemen, that I wanted to highlight as part of the letter, that BTC could potentially take the dollar's place. And I think this is such an interesting point, one that we have made for those that have watched the podcast regularly. I made this point a couple of weeks ago where Bitcoin has the opportunity to become the standard reserve currency. And this is a matter not just of strategic financial sense, but potentially of national security and protecting our own U.S. self-interest. Because the U.S. dollar is not just about dollars and cents, right? That matters. But it's more about U.S. hegemony tied to the dollar that can impact global policy and trade and regulation. I joke with Mark in our travels to the Middle East that I heard more classic rock in the Middle East than I listened to here in New Jersey. And that really represents the U.S. hegemony, not just within dollars and cents, but also in culture. And those two things are inextricably linked, in my opinion. So when we think about the world reserve currency potentially continuing to slide off the dollar and now looking at something like Bitcoin, well, then it's in the U.S.'s own self-interest to continue to buy more and more Bitcoin. So that executive order, in my opinion, was a good start in terms of what we need to be doing or we ought to be doing to ensure that if Bitcoin does become the global standard, the global settlement layer, that the U.S. remains in a strong place, just as it has done in my lifetime with its own currency. So in other news, let's see what other headlines we have. So we've mentioned about the TikTok news. That's not going to go away soon. We've got the deadline coming up. We've mentioned OpenAI, but I have promised you all that in the year of the snake, 2025, will be the year of IPOs and M&As. And we're seeing that AMD, the big rival to Intel, right? Before it was a big deal to have that little Intel Inside sticker on your computer. That kind of was a badge of honor, a merit that you felt that you had a powerful and expensive machine to do whatever you needed to do, whether it was just having a great spreadsheet or being a gamer. AMD is trying to rise to the challenge here. And they've completed a $4.9 billion with a B acquisition of ZT Systems. And this is to challenge NVIDIA in AI data centers. So NVIDIA is continuing to face more and more pressure. And just as we've said, when it comes to Web3, this is not something that is unfamiliar to the tech industry. Heavy is the head that wears the crown. Because at the top is Mr. Jensen with his leather jacket. He is gunning for the top spot in AI, and he has secured it, right? That was his goal, but it's something that other companies are not going to stand idle by, right? So the $4.9 billion acquisition of ZT Systems, it strengthens the position in AI data centers. and really allows for a more open source alternative to NVIDIA's proprietary, that's another word I stumbled on, proprietary AI infrastructure. And so this is very reminiscent here of what happened with OpenAI and DeepSeek, which we spoke about earlier. DeepSeek is the open source Chinese competitor to the closed model that is OpenAI, right? And so with NVIDIA, it's a closed source system. They use CUDA. And now with AMD, it allows them to really come into the game with another open source solution. And I think this is probably showing a little bit more of my bias, as listeners, longtime listeners of Digital Currents know, way before my investing career, I was a lifelong technologist. So I worked for a number of startups, built products, developed strategy, and try to take on the big boys, try to compete against Google, try to compete against Facebook. And in many cases, we were successful, so much so that we got acquired by some of those big boys, like Microsoft, like Verizon, AT&T, and Oracle. So it's definitely that idea of, if you can't beat them, join them, by the way of big tech. And it also kind of showed me this idea that in order to compete as a big tech company, you can't just sit on your laurels. You have to be aggressive when it comes to adopting new technologies. But that doesn't mean that you build them. No, 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 no. That means that you have to look for what is on the horizon, what can you acquire strategically and at the right price, because things like merger of equals, where you're buying something that's roughly the same as your own company value, historically terrible investment ideas. But if you can find smaller ones, bite-sized deals, well, then those have the potential to create a very big goal and benefit of bringing your technology up to par and the hopes of your stock price following suit. And we also don't remember some of the small acquisitions that don't go anywhere, right? Because if you buy something very expensive, that is something that the investors will not miss. But if it's something that's a little less expensive, well, that can be balanced on the other side of the equation by a better investment or by a strong quarter. Although they all matter, it's definitely worth to have a big mistake rather than a little mistake. AMD is going to town here with 4.9 billion. That is not a small mistake if it does not work. But ZT has got 1,000 engineers. They're now integrated with AMD's data center solutions unit. And they're trying to do more than just chips. They want a full stack AI computing solution and maintaining this open customer ecosystem. Last week, we spoke about the CoreWeave IPO. That was all about a software approach using NVIDIA chips and really allowing companies like Amazon and Microsoft and Facebook the ability to access the AI infrastructure and software that was built by CoreWeave. And I think of this example as, CoreWeave is much like the AWS for artificial intelligence. And so, let's take Amazon, for example. Amazon can do everything, right? But what they really focus in on and do better than just about anybody else is e-commerce. And as an e-commerce giant, they can't and they should not be bothered by creating their own proprietary AI and building out machines and having to worry about maintenance and having to get 1,000 new employees to do something they can literally flip a switch for somebody like CoreWeave. That business model is the reason that AWS, another great product over at Amazon, that's the reason why that's so successful. So AWS is Amazon Web Services. They are effectively the backbone for a lot of Web3. Actually, a lot of blockchain companies use Amazon's web services to power their solutions. They don't go out and build rigs or build computers from scratch. They just pick up the phone, or I guess now they'll shoot an email or they'll use an AI agent to do it for them to get the computing power and services that they need. And that's exactly what CoreWeave is doing. And that is exactly the idea behind AMD creating this new AI factory that's going to allow them to compete with the big boys of NVIDIA. So we will continue to see if this is going to be substance or fluff in the coming months. And I don't think that this kind of activity will slow down. I think that it's going to only continue to accelerate as we start seeing more and more companies come and embrace AI. And in order to do that, more and more investment needs to continue into AI. So how can you be saying the two things, Xavier? You're reconciling on one side at the start of the show that OpenAI had $40 billion in funding, and that's a princely sum. But at the same time, we're also expecting the market to continue. Yes and yes. It is a princely sum, and also this will continue in the market for the year of the snake, aka the year of IPO and M&A in 2025. So just as I did last week, and as we do every week, just because Mark is not here, I will take the burden upon myself. I will do the heavy lifting of both sharing my screen as well as narrating the chart of the week. This is the part of the show where I remind our users and our listeners, as always, to check us out on YouTube. This is where you can see if Mark is real or has he been deep-faked. What is the Bitcoin stock reveal? Surprise, there is no Bitcoin stock reveal this week as Mark is out. But there is, and always will be, a chart of the week. It's a great way to show what is happening in the market. If a picture is worth 1,000 words, a chart is like a fancier picture with math. So that must be worth, let's call it 1,000 plus X words to kind of phrase that mathematically. And so I am going to share my screen. And for those that are on audio only, I will describe what you are seeing so you can follow along right wherever you podcast. What I'm going to show first, it's kind of a twofer. It's a bonus. So again, I'm not feeling burdened, folks, but I will take this burden like Frodo from Lord of the Rings and walk you through the charts of the week. The first that we're seeing is Bitcoin's acceleration phase, or their drawdown percentage. And so this is showing what's happened since 2010 through the present day, backdated by about a week. And it's showing that, this is nothing new here. Even though Q1, we've had the worst Q1 in 7 years, there have been immense periods of vol, inclusive of drawdowns in Bitcoin's history. So this is just par for the course in this respect. And we're seeing that, in other periods, just even going back a couple of years to 2021, the drawdown percentage was around 50%. And going back to 2013, 70%. So it's important as we look at this to take a step back and recognize that there have been, and we'll count them, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 different periods of double-digit drawdowns since 2010. So definitely something to allow us further perspective on the market. And I did promise a double feature. I did promise a bonus. So what's the second chart? Here we go. The Bitcoin number of all-time highs with a rolling 60 days. So you're seeing this interesting chart here, right? It kind of looks like the Himalayas, right? Except it's a little bit misleading. Maybe it's Patagonia because the Himalayas actually start at a not sea level. This is starting over at 0, but you get the analogy here. Super high peaks and then low troughs. And what this is trying to illustrate, and this was actually an idea that was put forth, and I'll give credit where credit's due, Fidelity analyst by the name of Zach Wainwright, he noted that in these periods of recent post-acceleration phase, so the last chart that we're showing with the drawdown, there is this performance phenomenon that will align with this cycle. So to be said another way, when you've got the drawdown, effectively when you've got low tide, you wait for high tide. So this is showing immense gains. If you look at history and what's happened during these drawdown periods, it could lead towards new all-time highs. And what Mr. Wainwright over at Fidelity has put forth is an anticipation that Bitcoin can soon challenge its all-time high with an initial base of 110,000. Now, I don't want to sound like I'm being overly predictive or potentially being misconstrued as some sort of a rapture event. No. I am simply saying that if we look at history, and for those that listen, I am a longtime history major and history buff. That's my thing. But I also love markets. I also love investing. I also love text. So if you put all of these things together, you can really look at trends in the market. And when in doubt, zoom out. That's the quote of the week. It's one that if you are in Web3 and crypto, you're probably rolling your eyes right now saying, Xavier, you're really going to hit us with the when in doubt, zoom out. Yes, I will. Because if we're thinking about what's happening in the world right now, whether it's interest rates, tariffs, geopolitical conflicts, all of these things don't really interfere with what has happened historically when it comes to the computing protocol known as Bitcoin and its cyclical patterns of highs and lows. I think now one of the most dangerous phrases in finance, no, but this time really is different. I'll say it in closing and risk getting my hand slapped. But this time really is different because now the number of people, the number of institutional investors is incredibly high. Going back to a couple of weeks where we showed you a list of over 500 institutional investors with the majority either investing or highly considering investing 5% of assets into Bitcoin. This time really is different because Bitcoin itself has now become a legitimate asset class with 24/7 trading available not just through places like a Coinbase, but trading now also available through ETFs, 110 billion last year of inflow. So while we have seen a rough Q1, if Mr. Wainwright is correct, this could be setting us up for a brighter future where we can kind of look at this as an opportunity. So when in doubt, zoom out. I'll leave us on that note. And like I say every week, please make sure to rate, review, and subscribe. We love the engagement that we're getting across our platforms. And I'll remind our listeners, like I do every week, stay current. Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.